All right, let's cut through all the noise, all the headlines. We're going to look at the raw data. You know those whispers about a global recession? They're getting louder. So the question is, are they about to become a full-on roar? And that's a really crucial point. Recessions don't just pop up out of nowhere with a big, scary headline. They send signals first. So think of it like this. We're basically economic detectives today. We're on the hunt for the clues, right? The patterns, the little indicators that show up way before anyone officially calls it a recession.
So let's just put the big question right on the table. Are all these signals we're seeing pointing to a huge, coordinated global downturn? Well, to figure that out, we've got to look at the evidence, piece by piece.
Okay, first up, let's get into the classic indicators. These are kind of like the canaries in the economic coal mine, They're what the pros watch for the very first signs that something might be wrong. So, the first signal, it's called the inverted yield curve. I know, it sounds super technical, but the idea is actually pretty simple. So imagine you're lending someone money. You'd expect to get paid more interest for a 10-year loan than for a 1-year loan, right? That's just common sense. Well, an inverted yield curve is when that flips on its head. It's when the market is so spooked about the near future that investors are actually willing to take less money just to park their cash somewhere safe for a long time. And historically, this thing has been an incredibly reliable recession predictor.
And doom. This chart right here shows you exactly what I'm talking about. See how the short-term yields are actually higher than the long-term ones? That's the inversion. And let me be clear, this is not just some boring technical detail for Wall Street. This is the market, a huge collective of investors basically screaming at the top of its lungs that it sees a slowdown coming.
But here's the thing. The inverted yield curve isn't a solo act. It's more like the lead singer in a band of bad news. It's being backed up by a whole chorus of other pressures. We've got slowing GDP growth, central banks are just slamming on the monetary brakes to fight inflation, consumers are getting nervous and closing their wallets, and factories? They're starting to power down.
And that last point about factories brings us to something called the Purchasing Managers Index, or PMI for short. The easiest way to think about it is like a monthly health check for the whole manufacturing sector. The magic number is 50. If the PMI is above 50, things are expanding. But below 50, that means contraction. And what we're seeing now is that critical line being crossed in more and more key economies around the world.
So as if all those internal weaknesses weren't enough, right? The global economy is also getting hit with a massive punch from the outside, a potential energy crisis. And this isn't just another problem. It can act like throwing gasoline on a fire, turning what might have been a simple slowdown into a full-blown, painful recession.
And the impact here is immediate. It just cascades through the whole system. Think about it. High oil prices mean it costs more to ship everything. Those costs, they don't just disappear. They get passed on to you and me as higher prices at the store. And what happens when we're all feeling squeezed? Well, we spend less. It's this nasty, vicious cycle that is incredibly hard to break.
The analysts, the people who watch this stuff for a living, they have their eyes glued to one specific number, $150 a barrel. The thinking is, if oil gets to that level and stays there for a while, that could be the breaking point, the moment the global economy just can't take it anymore.
So the really crucial thing to get here is that this is a two-pronged attack on the economy. It's not just one thing. On one hand, high energy costs smack consumers right in the wallet through inflation. But on the other hand, they also directly squeeze the profits of businesses. And when businesses make less money, they invest less, they hire fewer people. It's a real double whammy.
Okay, so it's pretty clear there's a global storm brewing. But just like in any storm, not every ship is built the same. Some are better prepared than others. So let's break this down by region and see who's best positioned to ride this out, because every major economy has its own unique weak spots.
So if you look at the United States, its biggest weak spot is how sensitive the economy is to the Fed raising interest rates. For Europe, oh man, they are on the absolute front lines of this energy crisis. It's a direct hit. And then you have Asia's powerhouse economies, which are so dependent on exports, any slowdown in global trade hits them really, really hard.
And this table here really brings that whole risk analysis into sharp focus. Just look at it. Europe is pegged at a very high probability of recession, and that's driven almost entirely by the energy crisis. The US? Not too far behind. Asia's a bit more of a question mark. Its fate really just hangs in the balance, depending on whether global supply chains can hold it together.
Okay, so the economic data tells us what's already happened, right? It's like looking in the rearview mirror. But if you want to see what might be coming up ahead, you have to follow the money. So how are financial markets, traders, investors, how are they reacting to all these signals we're talking about?
I mean, this is the ultimate question if you're an investor, isn't it? Markets are basically giant betting machines, constantly weighing all this data and placing their bets. And in times like these, when there's so much uncertainty, money does not sit still. It moves, it looks for a safe place to hide. It's constantly trying to price in all this risk. So, what's the verdict? What is the market telling us?
Well, the verdict in a single word is fear. Take a look at this chart. It's showing a massive spike in a major volatility index. A lot of people call this the market's fear gauge. It's about as clear a picture as you can get of just how much uncertainty and risk aversion is creeping into the system. And this spike in volatility, it's not happening in a vacuum. It's part of a much bigger, classic trend we see in times of trouble, the flight to safety. What that means is we're seeing huge amounts of money just rushing out of riskier things like stocks and pouring into things that are seen as super safe like U.S. government bonds. And by the way, that's also why you're seeing the U.S. dollar get so strong. Global money is looking for a safe harbor to wait out the storm.
All right, we've looked at the early warning signs. We've talked about the energy shock acting as a catalyst. We've broken down the risks by region, and we've seen how the market is nervously reacting. So now, it's time to put all those pieces together. Let's synthesize this and figure out what it all means.
And this, right here, is probably the most important thing to take away from our whole conversation today. A recession isn't something that gets declared in a headline one morning. No, it's revealed, slowly, through patterns. And the patterns we've just walked through, well, they're telling a very clear and frankly, a very concerning story.
So here we are. We're at a really critical point. The signals are flashing bright red. The markets are completely on edge. At this point, the real question isn't, is a shock coming? It's, is the global system strong enough to absorb that shock when it finally hits? And that, well, that's the trillion-dollar question, isn't it?